Good afternoon and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're winding down the day at Quinnipiac G.A.M.E Forum over in the heart of New York City. And joining me for this segment, we have Jamie Farmers, a Managing Director over at SPGGlobal, and we're going to focus on Indexing 101. Jamie, thank you very much for joining us today over at G.A.M.E. So let's get into this. What's the theory behind index-based investing and how is it being implemented in the markets today?
Sure. So, flows into passive vehicles, index-based vehicles, are very much a now phenomenon. We see a lot of that playing out in the press, but they're really properly evidence of a body of research that's built up over more than a half century. If we start with Harry Markowitz's modern portfolio theory, Eugene Fama, efficient markets hypothesis, William Sharpe, Charlie Ellis, all laid the body of research that has really created the grounds on which ETF, futures-based, passive-based vehicles are really expanding right now. And while the notion of investing according to an index when it first came about in the 70s was heretical to a lot of people, that body of research has really demonstrated how significant that has played out in reality. While that body of research is significant, we really see that body of research played out in something called the SPIVA research that we produce. And what that SPIVA research does is, over the last 15 years we've calculated, it shows the performance of active mutual funds versus their relative benchmark, an appropriately chosen benchmark. And what we see is, time and again, in geographies, asset classes, cap sizes, over significant periods of time, the majority of active managers underperform their appropriate benchmark. And I think that idea has really taken root, and you see more and more flows into passive vehicles as a result.
All right, and so what are the different adoption trends that you're seeing among different types of market participants?
Yeah, it's pretty significant. I mean, we see early adopters tend to be more astute. The very first index-based fund came about in 1971. It was an in-house fund for an institution. Vanguard created the 500 index fund shortly thereafter. But the early adoption of some of the tradable products like ETFs was mostly hedge funds. But over time we've seen retail pick that up. We see financial advisors pick that up. We see very astute asset owners like pension funds, sovereign wealth funds, asset owners like insurance companies using more and more passive vehicles as part of their portfolio construction.
So what are some of the milestones and frontiers that passive investing into the industry, what does it really become?
Yeah, I mean, it's fascinating to see how things have evolved. And we started out with broad market indices. We evolved through cap size indices, small, mid, large cap, sector carve-outs. Some of the new frontiers are things like factor-based investing, which really seek to amplify or attenuate a particular driver of investment returns, something like volatility or dividend yield or momentum. And now we're starting to see things like ESG really become a factor. Environmental, social, governance factors, how to apply things like value creation economically with value creation in sort of a societal context as well. Some of the more astute investors in the institutional space are looking to combine factors like that. We see fixed income expanding more, multi-asset class expanding more. All of these are really sort of the forefront of index creation.
All right, well, thank you very much for sharing that with us
pleasure.
today. And thank you for spending the day with me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.